Welcome to the Art of Money Podcast with Art McPherson.
And this is the Art of Money Podcast with Art McPherson and Luke McCarty, artofmoneyradio.com for more information on the McPherson Financial Group or to schedule that initial complimentary consultation. We appreciate you listening. Now, let's get to the show. As we close the financial book on 2022, it's something we discussed every weekend here on the Art of Money. It was bad, but Luke McCarty, how bad was it really?
It was pretty bad. I mean, it ended really bad. If you look at historical levels, the S&P 500 was down about 20%. That's the largest 500 U.S. companies in the stock market, right? The NASDAQ was down 34%. So if you had, some Tesla or some, even Apple or Google or Microsoft, you're going to be down 20 to 35%, if not more. Kathy Wood, her flagship innovation fund, it's down more, right? So the more risk you took last year, the more money you probably lost. The hard part about last year was the bond market. So the bond market ended the year down negative 13%, one of the worst years for the bond market. So your historical 60-40 type of portfolio where you have 60% of the money in stocks, right, down 20 to 35%, 40% of the money in bonds, down 13%. It's the third worst year ever for a 60-40 portfolio, coming in negative 17%. Only 2 years were worse, 1931 and 1937. So It was a tough year.
And both of those were during the Depression. So,
right. So we're making comparisons to the Depression, even though it doesn't feel like a depression, and all the while, the Fed raised interest rates, 4.25%. So the Fed is not on our side, and we'll see what they do this year. I don't think they know what they're going to do.
Yeah, it just basically was one of those years. When you look at the bond market, it by itself was the worst year ever in bonds. So, you're talking about a time frame where being safe didn't help, and then you had inflation eroding savings. So if you were trying to keep money in the bank, you were still losing because inflation was high. We peaked at 9% last year. So it was just one of those years where nothing seemed to work in the traditional modeling platforms. That's one of the reasons we have all kinds of ways to try to, make money in a bad market cycle and protect money when things go bad. We've got kind of all across the board this year predictions, of what the market's going to do. We've got some people saying the market's going to do really well. We have some people saying the market's going to continue to go lower. The prognosticators, how right are they? And the experts, how right are they? Most of the time they're wrong, and usually somewhere in between, the extreme high and the extreme low. Sometimes, usually we fall in between those numbers.
Good point, Art. When it comes to the experts, right? The experts last year predicted for 2022, right? The median forecast for the S&P 500 was 4,821, right? The highest was about 5,300. The lowest was 4,400. We ended last year in the S&P 500 at 3,839. So all of the experts were way off. They were way high. When we look at that for 2023, right, the median forecast is around 4,000, but it's the most bearish outlook since 1999 and the widest dispersion of a range between 3,400 and 4,500 since 2009. So it seems like a lot of these experts are now expanding the potential of what could happen this year because there's so many unknowns going into this year.
In other words, it's like a hurricane cone that's really wide right now,
really wide.
And it'll start narrowing as we go forward. So everybody's having a tough time knowing where that hurricane's going to come in at.
Yeah, so we don't make predictions here because of that. Nobody has the crystal ball. Mm-hmm. We just put things in the portfolio that can make money in either direction, and put things in the portfolio to help reduce your risk.
All right, so let me ask you this. How did you, Art McPherson, looking back on 2022, how did you help protect your clients so that they could protect those assets and continue to have confidence in their retirement plans? What are some of the steps that you took?
Well, one of the things we do automatically with everybody, it starts usually on our second appointment with them, is we talk about reducing portfolio risk. So there's ways to do that. So one of the ways we do that is we can put you in a managed model that actually reduces risk itself. The model is designed to reduce the risk. So we're trying to get market-like returns with about half of the market risk. So we do that right off the bat. But then we try to use non-correlated investments that if we do have a bad cycle where we have a bear market, which what 22 was, it was a bear cycle. It was a bear cycle for bonds, a bear cycle for every equity platform out there. So when you have a bear cycle like that, you want to be able to benefit from that, but also help protect money in that period. And then we also had a very unusual situation where we had interest rates rise, like Luke said, over 4% for the year. So what we couldn't even look at December of 21, now in December of 22 became very positive. We could go out there and get fixed rates in the 4 and 5% range again. So there's all kinds of different things you can do throughout the time frame, but it's making sure you're in positions that are flexible and you're not just all your money in one bucket. You want to make sure you've got money that is safe and stable, that can give you a good positive growth rate. But when everything is going down, like the bond market, stock markets, that you have some of your money that is not tied with that so it doesn't go down.
So looking back and using a little hindsight onto 2022, what does your portfolio look like? Did you lose as much as the market average? Did you lose less? Did you lose more? Are you not happy with your situation? We'll give the team in the McPherson Financial Group a call. Let's begin that conversation. Let's make some adjustments, but more importantly, let's build upon what's working. And if you have that $500,000 in assets, Art is offering a complimentary income plan with no obligations and no fees attached. 321-425-8550. Let's kick off 2023 with some confidence into your retirement plan. You know, we talk about the myths of retirement here on The Art of Money, and Forbes says one of the most common myths is that we'll be in a lower tax bracket when we quit working. Now, that seems to make sense, but why could that not be true?
The usdebtclock.org, that website with $31 trillion in debt.
Every time Luke does a seminar, he uses that website.
I have showed a big old picture of it. I've even shown it in the conference room. It just gives people headaches, so I try to avoid that. But, your tax bracket can fall in retirement. You know, if you saved a lot of money and you're in a low tax bracket and you don't anticipate spending a lot, there's potential. But for most of our clients, it's either the same or higher when they retire. And after the Trump tax cuts, more than likely everybody's taxes will be higher in retirement. Instead of 12%, you're paying 15. Instead of 22, you're paying 25. So we feel that, as some of these new budgets get passed at the, last deadline of 1.7 trillion. I know Mark Bernard's going to join us next week, but one thing they're doing is they're extending the required minimum distribution age. Well, they're doing that because when your beneficiaries get that money, they have 10 years to take it out and taxes will be higher, theoretically, right? The only way that doesn't work out is if they go down, and I don't think they're going down.
Yeah, not when our government spends like drunken sailors.
You're not wrong on that one. And Mark Bernard will join us next week to talk about some tax tips on how to have a plan for 2023 as the government continues to... What was that website again? US?
The website is usdebtclock.org. But if you look up that new $1.7 trillion spending bill, and you can find it in PDF format and it doesn't crash your computer with 8,000 pages, search for the word salmon, the fish. It's like in there 60 times.
Are you serious?
We have a government spending budget of $1.7 trillion, and there's, the fish gets more money than you, me, Mark.
I think I think we have $450 million that goes to about 4 or 5 foreign governments, not including Ukraine. But yet, I think, what was it? Our past president, Trump, wanted $3 billion for the wall, to finish the wall, and they said no.
They almost shut the government down.
$450 billion. I know.
Yeah,
but we're going to send $450 billion to protected borders for foreign countries.
For other countries.
That seems weird to me.
Woosah.
Yeah, a lot in that bill. Now, Mark's not going to digest the whole spending budget. We're just picking.
Next week's show is going to be 14 hours long.
We're just going to talk about how it affects our clients.
Crypto. Luke McCarty, I'm coming to you on this one because it's all over the news and you're kind of my crypto expert. Shark Tank investor Kevin O'Leary was paid by the FTX crypto exchange to be a spokesman, but he tells CNBC that he ended up with nothing when it finally collapsed.
Total deal was just under $15 million, all in. I put about $9.7 million into crypto. I think that's what I've lost. It's all at zero. I don't know because my account got scraped. All the data, all the coins, everything. And then I lost the money I invested in the equity as well. Those are zeros too. It was not a good investment, okay? I don't make great investments all the time. Luckily, I make more good ones than bad ones, but that was a bad one.
So FTX in a world of hurt right now. But the question is, what happens to your assets if the company that holds your bank, your brokerage, your 401k, or your crypto accounts, what happens if that goes under?
Well, in real world, in real assets, right, you have the SIPC insurance coverage. So if a Schwab or a Fidelity or Vanguard were to go under, your account can't be wiped clean like the FTX account. That's not regulated, right? Those crypto accounts are not regulated. So There's no rules. There's no governing body behind them. Whereas your big major custodians have backing into them. They have insurance in them. Now, of course, the value of the stock, right, can go to zero, but it can't just be wiped away. So if you own shares of Microsoft and Charles Schwab goes under, you still have those shares of Microsoft to your name. But let's be real, if Fidelity and Schwab go under, we have big problems. But this FTX crypto collapse is a really big problem. And it's interesting that Kevin O'Leary, he seems so confident, right, in the show, and he always makes these good investments. And I mean, he's lost millions. Tom Brady and Giselle have lost millions. All these, Kim Kardashian got sued for crypto because she wasn't licensed by the SEC. I mean, all sorts of crazy stuff is coming out about crypto. So as Art and I have said, got to be careful.
Yeah, we had talked about crypto. They really started getting a lot of headwind when you saw Bitcoin go from about $3,000 a coin up into that 10,000, got a lot of interest, started getting national play, rode all the way up to that 65,000 level. But one of the things we all said from day one is make sure you're putting your money in there like you would at Vegas, because there was no governing body. There were no guarantees. It was basically pure speculation and just demand. So if you get somebody like an Elon Musk puts $35 billion into crypto, wow, that drives that price way up. But when he takes his 50 billion or 60 billion out because he made nice profit and he wants to pull it off, you don't know when he's doing that. He announced when he put it in, he didn't announce when he pulled it out. So those kind of things can make a big impact. And then you can see the smaller derivatives of it, like the FTX platform, went belly up when all this mess happened. So you got to just be very, very careful.
Do you find it's a generational thing, Luke McCarty, that the younger generation finds a lot of intrigue and maybe an advantage to crypto as opposed to like an older generation where like, nope, I'm going to keep my money a little more safe and secure?
Yeah, I think so. I think the younger generation has been riding the wave of the Federal Reserve since 2009, where there was a lot of money in the system. When the government's pumping money into the economy, into stocks, into our pockets, there's a lot of potential easy investments to make where you can kind of get rich quick. And so you have a couple of those hit, and then you hear about Bitcoin and crypto and you want that to hit. And for some it did, for most it's gone down. And so, yeah, I'd say the younger generation hasn't had a Federal Reserve against us and hasn't had a lot of liquidity taken from the market. So some of their investments, and some of my friends, they're firefighters or, not in this industry, they were riding the wave pretty high a couple of years ago. And now they're coming down pretty quick.
Mm-hmm. And they tend to never know when to get out. They
right.
like, oh, no, I'm stay in. Everybody says stay in, don't bail. Just keep it and just use it to pay for stuff. But it's just kind of that same old story. You typically will buy at the wrong time and not know when to sell. Try to write it down when it's actually not a good time to write down.
Is the old theory of I can't physically hold it, so I don't know if I want to invest in it. Like I could put my hands on a Coca-Cola or a Home Depot or a Walmart or something like that, but I can't physically hold a crypto.
Yes, but what happens with the millennials is they have all these apps, right? So you can actually do an app right now, open an account just by giving them a few bits of information, and then trade in stocks and all that kind of stuff pretty much very low cost, very low fee, and buy and sell. So it feels as real as that, right? Mm-hmm. So it's hard for them to delineate the difference. Now, an older investor who's been through a lot more than just the app side of trading, they know the rules, they know the regulations, and so they don't really get caught up in the crypto space. But crypto seem to be the same. You're just pushing a button on the phone, just like you did to buy Apple, Microsoft, or whatever. So I can see how the millennials would get caught up and not really see the difference.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A1744725.
Today's show has been a work of art.